Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Now, in the mutual fund space, there's this propensity of retail investors to look at the past returns, and on the basis of the top performers in any given period of time, you decide which schemes to invest in or not. The thing is, that's not always the best approach to have, particularly when you can see very wild swings in the equity markets in a very short period of time. Take a look at just the last 12 months. In the run-up to September, you had the fag end of the upcycle in equity markets, and then from September onwards to where we stand right now, you've seen significant drawdowns, particularly at the broader end of the spectrum in the equity markets, as a result of which a lot of small cap and mid cap mutual fund schemes have underperformed, and also certain schemes that would have ranked at the top in September are no longer ranking at the top as things stand right now. So we're going to talk about two categories, that's the flexi cap category and the multi cap category, and talk about the winners as they stood in September and the winners as they stand as of now, just to drive home this point, and then we'll talk about how you should go about your own selection. Join me on this conversation. I have Santhosh Joseph, who is a founder of Germinate Investor Services, as well as Mirin Agarwal, who is a financial educator and founder of Finsafe India. Thank you so much to the both of you for taking the time. In the advice and in the conversations that you have, is it often the case where people ask you why not this scheme and why that scheme, and often the schemes that they're talking about, Mirin, I'll start with you, the schemes that they're talking about are the top rank based on the last year or 2 years or 3 years. Is that what you always find?
Good evening, Alex. And yes, absolutely. That's what one always finds, that the conversation always seems to be about the funds that are performing well in the last 1 year or who've got recent good performance. And typically, people don't even look beyond 3 year returns. So everything is based upon what is recent performance.
Okay. Santhosh, you want to build on that a little bit, because I'm pretty sure in the scheme selection that you do, sometimes the question is why this scheme is performed, say, has got an XIRR of what, 15%, whereas that is 24%. Why not pick that?
So yes, Alex, hi, good afternoon. Mirin was absolutely right. The desire to be in a fund that has got immediate past performance is very high. So there are two kinds of investors. One, they go around and check which are the funds that are done well and wonder whether you're recommending the same, and they ask you why not. The other group of people, after you have kind of discussed with them that these are the funds that you should consider, they go back and see how they have done in the immediate past. So in both the cases, either they're suggesting that to you, or if you suggested, they want to look if it's on the top of the game. So chasing returns is the order of the day. Now, whether they do it after you recommend or before you recommend, asking to be invested into that, it doesn't change.
Talk about the data though. Let's not base this on simply words. Mirin, any data that you might have to suggest that this is indeed the case? Let's first look at flexi caps and then we'll move to multi caps and see how that panned out.
Well, I was just looking at the data as of 30th September. And when you look at the 1 year returns at that point, and I often get questions on a lot of shows that I do on certain funds. Obviously it's because these were right at the top. So when I look at the data, there were funds whose 1 year return was, let's say, showing 60% in the flexi cap category, which have now come down to, let's say, 17, 18%. And as of 31st January, and of course, they don't remain at the top, right? So a lot of questions which are coming in on certain funds which were giving very high performance, and there are categories where the fund performances have also fallen drastically a lot. So when I look at like the top 5 funds as of 30th September and the top 5 funds as of 30th January, I think only two or three of them still remain as the top performers, but there are 2 of them which have gone down drastically, and there are others that have really come.
You want to talk about the names that you're talking about, just to drive home the point, and I'll try and pull that up on the screen as well.
Well, I think if you look at it, I mean, quant fund, for example, quant flexi cap which was one of the higher performing funds. That one's performance has come down. And if you look at, like, Parag Parikh, which is of course an all-time favorite of mine, and I would say for a lot of advisors, and I hear a lot of people also having Parag Parikh as well. And it was not one of the top performers in the September end, but when you look at it now, it is one of the top performers. So yeah, there are many other cases like this as well. Again, where funds were not there, who were not top performers in September, just in a matter of 4 months have come up at the top.
Okay, so 4 months can change quite a bit, and since that high point, Santhosh, we're talking about drawdowns of over 15% for the broader markets, right? So obviously schemes that were more aggressive in their allocation towards the broader markets have seen drawdowns. But do you want to add to the data points that Mirin has pointed out, maybe some of the reasons why some of the schemes that sat at the top of the ranking in September have fallen down in January?
Yes, Alex, I think what we could do is we could take, September end being the high point of most of the, top chart busters, and, look at them today towards the end of Jan, or maybe even right now. The numbers are very different from where they were about 3.5, 4 months ago to where they were today. Let's take an example. If you were to look at the flexi cap or even the multi cap category, there were winners in both the category. And let's take, as on September end, a classic all-weather fund like HDFC Flexi Cap was not there in the list of good performers. But the minute you change the date to and come to early February this year, you suddenly see that HDFC Flexi Cap has come right on top in terms of the way it's performed and the resilience it has shown against a sudden sharp correction in the markets. Likewise, the favorite of last year, like a Quant or even a JM Flexi Cap fund, which did so well up until September, October, right now seems to be also taken so much of the brunt in terms of the correction. So what is the learning over here? The winners up until September, October are not in the top list, and the guys that were missing in that list for maybe the whole of calendar year 24 or till the markets kind of peaked out in September, October, the guys were not performing then are performing now. Of course, we can discuss their portfolio moves, their cash holding, or their exposure to mid and small cap and the broader markets. But fact is, they have changed, and they changed in terms of diametrically that the names and the winners are different.
Okay, Mirin, what do you do with this data, with this information then? And ultimately, the bottom line is, how do you choose? Because if you're not choosing the winners in any given period of time, and here we're talking about point to point, so obviously you zoom out, but it's not always available. That data is not always available, particularly if we're talking about the two categories that I've chosen. And maybe that's a little bit of a googly for you to say that because these categories, split not too long back, you can't go too far back in terms of the data available. So from that perspective, how do you choose?
So the first question is that what do you do at this point in time if you have these funds and where you're seeing a huge amount of volatility, or you're seeing a big drop and you're feeling concerned about it? I think you need to really evaluate, why did you get into this fund and for how long, did you get into this fund for? I think it's also important to go back and look at how this fund has performed at different periods of time. And I'll be honest, Alex, I don't think that individuals can really do this on their own. You certainly need the help of a financial advisor. Now, one of the aspects when you're choosing funds, which investors tend to miss out, is the rolling returns, because that is a better way to look at the consistency of returns, where essentially the returns are taken over a period of time, and you are checking on a daily basis that how the performance has been, and then getting an average. So it's like an average annualized return that you're getting over a long period of time. So first and foremost, since equity is meant for the long term, you would want to look at 7 to 10 year returns, and you would want to look at the rolling returns over there. Again, rolling returns data is not very easily available online for anybody to just go and check. And again, which is why you would need to take the help of an advisor. But this is what I would really suggest, that if you really want to evaluate and do a review of your mutual funds, you really need to go back, see what has been the long-term performance of this category. And I know flexi-cap and multi-cap, because of the scheme categorization, the data may not be too long, but even then you might want to go back, look at the consistency of returns that have happened over the years, and then really see whether you want to continue holding this fund or not.
Okay, so let's come to the clincher then, Santhosh, which is in these two categories, and these are investor favorites for obvious reasons. Multi-cap has done incredibly well because of the forced allocation in the broader markets, and a lot of these schemes have pivoted over the course of the last several months to have a higher large cap allocation. But given the data that is currently available from your perspective, what are the schemes that you like and why, based on the strategies that they employ?
So, Alex, you're right that both the flexi cap and the multi cap are what we call the diversified equity category. Just the difference between the flexi cap and the multi cap is in the multi cap, you actually have a forced minimum requirement for broader markets, that is mid and small cap, and then the large cap. Whereas in a flexi cap, you do have the cushion given to the fund manager to decide upon the exposure to the broader market and the amount he wants or the lack thereof. Now, essential dipstick would tell you that these funds, if you were to start looking at them from the way they are positioned and the way the exposure to broader market is, it will give you some sort of a macro view about how these funds are positioned. And I think I'd agree with almost all of what Mirin said in terms of how you have to check on track record and check on rolling returns and check on how these funds have done in the past. But coming back to the way we are right now, I still think that if there's a flexi cap right now that has been more resilient to the market. Now, when you look at that, Parag Parikh stands out. HDFC stands out. Even in as part of such a sharp correction, even a fund like Edelweiss stands out. What are we looking at here? We're looking at how much did you capture in the upside and how much did you fall on the downside. Not all can get all the times right, but if you're able to do better both on the upside and on the downside, then you have a case for saying, I'd like this fund to be in my portfolio through market cycles. Now, sometimes the data that we are crunching is such a short period since the correction has started. 1.5, 2 months down from here, if the markets are back to all-time highs, then again, you'll have a distortion of data. So we have to be clear. It's also to do with the positioning. It's got little to do with what I think is my favorite right now, but it's got more to do how the fund is positioned. Let's take JM FlexiCap. Had a good exposure to broader markets, outperformed for 2-3 years and came top of the charts with huge margins. Now they have taken a beating, but again, broader markets perform like how just today in the second half of the day you had a recovery. You will notice that again, the funds which are holding more cash or more large cap oriented will tend to dip, and these funds will do well. I think positioning, understanding the positioning along with some sort of track record makes a great case for staying invested.
Okay. Fantastic. So we've given our viewers a bit of a sense as to how to approach this, and ultimately the bottom line, I'm sure both of you will agree, is to not take knee-jerk reactions if you are investing. And when the chips are down, the SIP approach or the SIP approach really allows you to accumulate more units. So that should be the objective, unless there is a very dramatic underperformance. Santhosh, Mirin, thanks so much for joining in. As always, pleasure speaking with you.
Thanks, Alex.
Thank you.
And with that, it's time for the second part of this conversation, which is what I like to call Wellness Wednesday. We talk about how you should build your wealth through the week, but we don't talk enough about how you should stay healthy. And this is an attempt to do just that. Today, I'd like to talk about diabetes. India has become, or is in the process of becoming, the diabetes capital of the world. There are more young people nowadays that are contracting this disease that has long-term impact on your lifestyle. To talk about how you can identify this, what are the signs and symptoms, and how treatment takes place, I'm joined by Dr. Shweta Budial, who is endocrinologist and diabetologist at Fortis. Doctor, thanks so much for taking the time. How often do you think that somebody should test for this? What are the early signs? And what should you do if you first contract it?
All right. So how early? It's something that depends on your risk factors. So if you are obese or overweight, there is no age limit. We should start screening for diabetes even in children if they are overweight or obese. If you have multiple risk factors, like if one of your or both your parents have diabetes, you're sedentary, you're overweight, or there's too much of stress in your life, you have other problems like hypertension or cholesterol problems, which are kind of linked, they are also related to diabetes, or you have had history of gestational diabetes, as in you had temporary diabetes while you were pregnant, you gave birth to a large baby, or you have history of PCOS, then you should start screening maybe from late 20s or early 30s. And I mean, no age is like a bar. If you have more the risk factors, the screening can be started early.
Are
And
there
second,
any physical manifestations that could point you to a potential diabetes?
right. So if you are mildly diabetic and your sugars are not terrible, you may not experience any symptoms, but still the damage related to diabetes or high sugars may be going on in your body. So that's why if you have risk factors, but if you don't have any symptoms, still you need to start screening yourself. And with less number of risk factors, maybe you can screen yourself for once in 2 to 3 years. If you have multiple risk factors, already your sugars have started becoming borderline or pre-diabetic zone, you should screen yourself once in a year's time. And generally, we see the symptoms of diabetes when the sugars are much on higher side, like your HbA1c starts exceeding 8.5%, your sugars start going beyond 200 milligram per DL. That's the time when you may experience the classic symptoms of diabetes, like excessive thirst, feeling fatigued and tired all the time, uh, going to the washroom more often, wounds not healing, itching on your body, or urinary or genital infections, unexplained weight loss. So these are all symptoms that we see when patients are severely hyperglycemic or when their sugars are quite high.
So, okay, so doctor, what we learn in the school books is about two types of diabetes. One is hereditary and one is not. And we've primarily been talking about the second type. If you are pre-diabetic, or if you've pointed out, as you pointed out, if you found out too late and you are properly diabetic, what should your response be? How do you treat this?
All right. So first thing is like do not panic. Diabetes is treatable condition. And if we keep the sugars under control, we can very successfully prevent all the complications. Second, if you have recent onset diabetes and you make a lot of lifestyle changes, lose a lot of weight, your diabetes may go actually into remission. You may not require medications, at least in the beginning. So the first and the most important thing is you have to see a doctor, an endocrinologist or a diabetes specialist, and understand what are the drivers in your body that are making you go into hyperglycemia or high sugars. And the second factor is like patients who have like very high sugars, they have symptoms, or sugars are likely to cause problems if they are not started on medicines. Those patients should start taking medications. And as I said, the most important treatment for diabetes is lifestyle intervention. So changes in your diet, physical activity, weight, stress management, adequate amount of good quality sleep, all that can help you to get your sugars down with less number of medications or even without medications after a while, at least in the beginning. So I think it's most important that you consult a doctor, follow the advice, go to a registered dietitian on regular interval and look after all these factors.
Okay. A few myths I would like you to bust. One myth, of course, is that if you have diabetes, that means that you shut off sweets completely. Is that incorrect? And two, is it costly to manage diabetes, and is it a strain on the pocket?
Right. So when you are a diabetic, you are carbohydrate intolerant. So either you are making less insulin or whatever insulin you make, it's not working efficiently. So obviously your sugars, the tolerance to any sweets or tolerance to any food items which is going to get converted into glucose quickly is going to be less. So ideally, the diabetic patient should say stay away from refined sugars or refined carbohydrates. But if your sugars are well controlled, you have lost weight, obviously your carbohydrate tolerance will again be like little better. In that situation, it is okay to have like around 1 to 2 spoons of sugar per day. But often we see that whenever we allow patients to have a bit of sugars, they end up going a little overboard. So we refrain from giving that advice, but it is okay to have like up to 2 spoons of sugar per day should be fine. But you should harp more on getting more amount of complex carbohydrates and proteins and fibers in your diet.
What are examples of easily available complex carbohydrates?
Complex carbohydrates are whole grains,
Okay.
like your wheat or even your millets. Millets are better than wheat in most of the patients that we see. So the jawar, bajra, nachni, all these things, millets, kodu millets, there are a variety of millets, region specific in India.
Yeah.
So
And would you
they
say,
have,
okay, and would you say that it's costly to manage diabetes, doctor?
yes, I mean, the cost of treating, I mean, most of the patients with diabetes also have other comorbidities like hypertension, cholesterol problems. Many of them already have gotten into complications like heart issues, past history of strokes. As a result, they have to be on multiple medications. So, on an average, a patient with type 2 diabetes who has multiple other problems may end up spending around 3 to 5,000 rupees on the medications. Some of the newer medications, when they are in a patented step or stage, the medicines may be expensive. Like, for example, if we talk about a molecule called semaglutide, the monthly cost can easily go up to 9,000 or 10,000 rupees.
A
So
month,
the
right?
cost, 9 to 10,000 per month.
Yeah.
So the cost really depends on the number of medicines that you're taking, what kind of medicines you take, and how intensively your monitoring has to be done. There are patients who are on multiple daily injections of insulin, and they have to monitor their sugars very rigorously, multiple times daily with a glucometer or continuous glucose monitoring system. So
Yeah.
all this adds to the cost. But what we should take into account is that in long run, when we manage diabetes well, all these treatments are cost effective. Like suppose if we don't take care of all these things, and a patient lands up with a complication or any severe problem and he has to get hospitalized, the cost is going to be way more. No, if one hospitalization and cost you the drugs worth 1 year's time. So if
Yeah.
we can prevent like hospitalization or even like poor quality of life, disability, in long run, these medications are actually cost effective.
True. So therefore, the point that you made about early identification becomes very, very important. Doctor, thanks so much for joining me today and for explaining the details of this very, very important subject. Thank you so much for joining me.
Thank you so much.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. This is NDTV Profit.